Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Nadia. We have with us Riya Singh, technical analyst, Currencies, joining in. Riya, welcome to the show. Riya, my first question coming to you is that the central bank has gone more tolerative towards inflation as the retail inflation numbers continue to increase for the fifth time. With this, how do you see it? I mean, what's your view?
Yes, true that. This is, because as according to the central bank statement, the recent surge in the inflation was more of a supply side driven and will only turn persistent when the demand kicks in. So, if you look at the strict lockdowns that were put in place to stem the pandemic, situations have actually crippled the activity and have throttled the demand in the economy. That's primarily driven by the domestic consumptions. Also, with the high taxes and rising unemployment, the consumers are also very wary of the spending, and this has put forth the uncertainty towards the future perspective. So, thus, I think if you look at the MPC needs statement, the central bank did do a revision on the GDP from 10.5% to 9.5% for the financial year 21-22, which is the evident of what the expected growth will be there. And this concern could dominate and thus could push out the policy normalization well into the year 2020. I think taking into consideration the current economic situation and the commitment of the central bank to not withdraw the help unless there is at least some recovery that will be evident in the coming numbers. I think RBI will continue with this tolerative stand, even as the retail inflation has tested 5%.
Right. So with all of this, now if you see with regards to the RBI's forex kitty, that's touched a high as well as the RBI OMO comes nearer. What's the kind of impact we could see on the Indian rupee?
Yes, if you look at the recent numbers, there have been a rise of $6.8 billion in the week ended June 4th. Now, this amount is well enough to cover around 15 months of imports, and it also puts a power at the central bank hand to intervene in the fluctuation of the rupee. Uh, but there are other scenarios that will be coming forward as well because apart from the forex, rise into the forex levels, the RBI will also engage into a 300 billion rupees of government bonds, especially in the state debt securities. So this would be an important event because if you look at the total FY22 gross borrowings, there is foresight that it could increase by 650 billion rupees on top of the 12.05 trillion that was already committed into the budget. Uh, this increase into the government borrowings have come forth owing to the recent government decisions to dismiss the vaccine decentralization. So this will swell the vaccination budget to around 450 billion to 550 billion rupees as against the estimated 100 to 120 billion rupees. So this is a huge jump from the estimated budget that the government has committed towards the vaccination progress. So this, and even if you look at the GST collection, it has taken a hit in the month of May. So this would this will further put pressure on the GSAPs and the OMO operations, which might have to be again reinforced to around 6 trillion rupees in order to support this government borrowing, as well as to balance the supply demand mismatch and keep the yields in a range bound situation. So, central bank will most probably intervene to maintain the relative rupee stability in order to manage the imported inflation that is coming from the oil prices, as well as to facilitate these GSAPs and OMOs operations. Also, with the imports down and continuous flow of the FPI and FDI in the domestic capital market, rupee will most probably maintain more of a consolidation to appreciative momentum on a shorter term with dollar weakness aiding the same. Thus, a wider range for the rupee momentum could be placed between 73.75 to 72.30 in the coming sessions.
Right. Riya, with regards to the dollar index as well, against a lot of currencies, in fact, the major ones, it's trading weak. And this is the fourth consecutive session of weakness. Are we expecting this weakness to continue? Because you do have the Fed meet around the corner.
Right. So yes, because if you look at the employment numbers, the major Fed meet revolves around the employment numbers and the pickup in the basic economic numbers. And there was some recovery that was seen, but again, if you look at the recent numbers, the employment numbers have have come down as the expectations in compared to the expectations. Also, if you look at particularly with the employment scenario, there is a high job openings, and two disappointing payroll reports have shown that the labor demand is recovering faster than the supply. But one must keep in mind why the employment numbers are so so important here. Keeping in mind that the Fed meet is coming up, because the jobless benefits will expire in June, July, and thus and I should be keep out for the weekly claims data, which will inform how quickly the workers are returning to the labor force. Even if you look at the May retail sales data, uh, uh, in the coming days, it will normalize due to the stimulus-related swing over the March-April period that was there. And this will provide important clues on the strength of the recovery in the key economic sector, thus laying a clearer picture towards the pickup in the dollar strength. For now, you can expect the dollar index to fluctuate between 90.82 to 90.10. And as far as the Fed goes, I think Fed will continue with the accommodative stance, because the employment numbers are still far from the recovery, and the basic numbers from the economic sectors, are still very sluggish as compared to the estimations that have been put out. So I think even for this uh, Fed meet, you can expect that Fed will maintain will keep the rates unchanged, and will probably maintain the accommodative stance.
Right. So, what are the strategies that you would want to recommend?
The strategies would be to go long into the USDINR above the level of 73.49 for a target of 73.62, 73.75 with a stop loss at 73.30. Go long into the Euro INR above 89.15 for a target of 89.28, 89.42 with a strict SL at 88.95. You can also go long into the pound INR above 103.41 for a target of 103.58, 103.72. Keep a strict SL at 103.24. You can, in the option part, you can buy USDINR 73.50 call at 0.19 with a target of 0.32 and stop loss at 0.09. This is a monthly expiry strategy.
Right. So, these are the strategies that one should be watching out for as well. In fact, I think, Riya,
Yeah.
I think you were not clear to few people, which I just read their message right now.
Okay. Do you want me to repeat these strategies?
Yeah, if you could.
Okay. So go long into the USD INR above 73.49 for a target of 73.62, 73.75 with a stop loss at 73.30. Buy into Euro INR above 89.15 for a target of 89.28, 89.42 with a stop loss at 88.95. Go long into the pound INR as well above 103.41 for a target of 103.58, 103.72 with a stop loss at 103.24. You can also buy into the options of USD INR of a strike price 73.50. So buy USDINR 73.50, call at 0.19 with a target at 0.32 and stop loss at 0.09. And this is a monthly expiry. So 28 June 2021 will be the expiry for the strategy.
Right. All right, Riya. Thank you so much for sharing the strategies, and apologies to everyone who could not hear. Thank you.